It is the 6th of March 2023. My name is David Hickson, and in today's market update we are going to be taking a quick look at the S&P 500 or SPX, gold and also Bitcoin. Before we do that, I must ask you to please make sure that you have read and understood these disclaimers. So let's start with a look at the S&P 500 or SPX, and the big issue in the S&P 500 that we've been discussing for several months now is what is the magnitude of this trough in the middle of October. You will know that it is possible in another analysis that we are tracking that is in fact a trough of the 18-month cycle. You will notice that in this week's video I have left the display of the circles and whiskers of the longer cycles that I have hidden in previous market update videos, because in today's video I am going to open up the discussion again and consider what is happening with that 18-month cycle trough. And is it really possible that it did form in October, or is it still waiting ahead of us? Here, of course, is the nest of lows for the 18-month cycle trough according to this analysis. In recent market update videos, I've been focusing on the 20-week cycle trough, and as I have discussed in previous videos, we have been expecting a 20-week cycle trough to form. On Thursday of last week, the market seemed to form a trough of sorts, and it is certainly possible that that could be a trough of the 20-week cycle. So let's have a look at this in a little more detail. First of all, we were of course expecting a 20-week cycle trough to form, and so it was not a big surprise when a trough did form in the markets last week. If we measure the number of days that have elapsed since the October trough, you will see that that trough that formed on Thursday last week formed after 140 days had elapsed since the middle of October. Now, the average length of a 20-week cycle discovered by Hurst 50 years ago is 136 days, and so that makes Thursday's trough a very viable position for the 20-week cycle trough to have formed. Similarly, if we measure the number of days that have elapsed since the 80-day cycle trough that probably formed in the week before Christmas, you can see that 70 days elapsed up until Thursday of last week. The average length of an 80-day cycle, again discovered by Hurst 50 years ago, is 68 days, and so that is a very viable position for that 80-day cycle trough because of the principle of synchronicity, which tells us that the troughs of cycles occur synchronously where possible. We know that the 80-day cycle trough and the 20-week cycle trough, marked by these circles over here indicating when we are expecting those troughs to form, we know that those troughs will occur synchronously. In other words, they will occur at the same time, which means that last Thursday's trough is a very viable position for that 20-week and 80-day synchronous cycle troughs. But whenever a trough forms in the market, we do need to play devil's advocate and ask ourselves whether we are really convinced that this is a cycle trough, because of the number of times that the market will provide a fake move or an artificial bounce where price appears to bounce out of the expected trough but then falters and drops lower down into a lower trough. Simply counting the number of days is not really adequate in terms of confirming that a particular trough has formed. And I should point out the reason why I have left these circles and whiskers for the longer cycles on this particular analysis, that if this is an 18-month cycle trough that is forming now, it doesn't really make sense for it to be forming so much higher than the trough that formed in the middle of October. And so we definitely have an anomaly. Let's take a look at the FLDs to see whether they give us further information. Starting with the 20-day FLD, we have a sequence of interactions that we track, which I discuss in many of these videos. There is a sequence of 8 interactions, the first interaction following a trough of 80-day magnitude, which the trough in December certainly was. We have an A category interaction, which, as discussed in previous videos, was a little bit messy because that was the period of time between Christmas and New Year and into the first week of January when trading is fairly fairly quiet, and so we didn't get a good clean A category price cross of the FLD, which is what we would normally expect. Price did, of course, achieve its target, and it even exceeded it. At around about the time of the 20-day cycle trough, we would expect a B and then C category combination where price finds support at the level of the FLD. You can see price didn't even come down to the FLD to find support, but it did over here, which at the time we were considering as a potential early 40-day cycle trough. Whether that 40-day cycle trough did in fact occur here, or perhaps over here, or even as it is faced in this current analysis at this position over here, is something that is up for debate. And so we do have some uncertainty around the position of that 40-day cycle trough. But the next interaction where price crosses below the FLD fairly clearly occurred over here in about the middle of February, where price crossed down below the FLD almost by default by virtue of the fact that the FLD was rising very strongly over the weekend, and price opened on the Monday below the FLD, even though of course it opened on that Monday at a price level higher than the price level it had been on the Friday. That would be our F category interaction. Price coming back up and finding resistance at the level of the FLD is labeled a G and then H category interaction for our final move down into the 20-week cycle trough, or potentially greater magnitude cycle trough. This interaction is then expected to be an A category interaction, where price bounces out of the 20-week cycle trough and projects a target to the upside. But there is always a danger when we are expecting a trough of 80-day magnitude or greater, and that is the big question of, is this an A category interaction, or are we going to witness a G category interaction over here? Because we have already seen a G and H category interaction, there is the danger that we might see what is called a double GH category interaction. In other words, is price going to find resistance at the level of this FLD and then move down and form a later cycle trough, which would be in line with the analysis shown on this chart, indicating that we are expecting a greater magnitude cycle trough? Or is price going to cross above that FLD and achieve its target and confirm the fact that the 20-week cycle trough has formed? So let's take a look at this price interaction, and we can zoom in even a little bit more and consider exactly where price has crossed this 20-day FLD. We need to display price as a median price, that is the mid price between high and low price for each bar, because it is the point at which the median price crosses above or below the FLD that is considered as the price crossing level. You can see that this median price has crossed above the FLD at a level of about 40.15. Measuring the distance from the recent low point, that generates a target at a level of about 41.09. But I should point out that I am recording this video on Monday morning in Europe, and the markets in the US haven't even opened yet, and so the median price for today's price action is based only on overnight trading on Sunday night in the US. And so this median price is certainly not the correct median price. And so this target over here is an estimate based on a median price that is not yet correct. I have now added the 40-day cycle FLD onto the chart, and it is going to be very interesting to see how the market responds to this 40-day cycle FLD. This is certainly the level to be watching this week. If the 20-week cycle trough, or indeed greater magnitude cycle trough, formed last week, then we would of course expect price to cross up above the 40-day cycle FLD and to reach the target that it will generate as a result of that price cross, which would probably be a target right up here at the top of the chart. However, if the 40-day cycle FLD provides resistance and price fails to get above that 40-day cycle FLD, then we must consider the fact that this trough still lies ahead of us. It is interesting to note that the target generated by price crossing the 20-day FLD, based, I should remind you, on an inaccurate median price for today, is above that 40-day cycle FLD. This is the beginning of what we would call a cascade pattern. A cascade pattern usually consists of more than 2 FLDs, but this is a very small cascade pattern, if you like, consisting of only these 2 FLDs. As a matter of interest, this quandary that we face when price is expected to form a trough and does then bounce out of it and cross an FLD, particularly when it does so late on a Friday or towards the upper end of the price range for a Friday bar, we are presented with the quandary of should we have jumped into that trade. I never recommend jumping into a trade late on a Friday afternoon, and because of the fact that we are asking ourselves, is this an A category interaction or is this a double G category interaction, we often in fact miss an A category trade, because jumping into that A category trade can be a fairly risky thing to do. What I do personally, and everybody takes a slightly different approach with this, is that I usually miss the A category trade. I don't worry about it. I simply watch that A category trade. For an A category trade to be a really good one, we would expect the target to be reached. So we already have a target over here, although we will need to adjust it according to today's median price. But we have a preliminary target, I should say, of 41.09. If price reaches that target, then comes down and finds support at the level of the 20-day FLD at about the time that the 20-day cycle trough is expected to form, that would provide us with our perfect trading opportunity in a B and C category combination where price finds support at the level of the 20-day FLD and then continues its move upwards. Of course, if you don't feel like waiting until the 20-day cycle trough forms, then you might need to be trading a shorter cycle. This sequence of interactions works with all cycles, with some modification required as you move into the shorter intraday cycles, but you could certainly be watching a much shorter cycle, a 2-day cycle, a 1-day cycle, a 5-hour cycle, if you want to be making more frequent trades. As a matter of interest, because we are considering the potential magnitude of this trough that formed in October, I'm going to show the other analysis that I've been tracking. I haven't shown this analysis for several weeks in these market update videos. This analysis, of course, indicates that the 18-month cycle trough formed in the middle of October, which would mean that the trough that has formed recently or is in the process of forming is of 20-week magnitude. Here is our nest of lows for the 20-week cycle. Now, let's quickly address the fact that this 20-week cycle nest of lows is so straggly. What I mean by straggly is that the circle for the 20-week cycle is actually way back in the middle of January. And you can see that we don't have a neat stack of circles and whiskers right above one another. Everything is sloping over to the left. The reason for that is revealed by taking a look at the recent average wavelengths of these cycles at the bottom right of the chart. You can see that the 20-week cycle has been found to have been running very short with a wavelength of 13.5 weeks. The 80-day cycle has also been short with a wavelength of 51.8 days, as opposed to 68 days, which is the average length that Hurst discovered 50 years ago, and over time the 80-day cycle continues to average at 68 days. And so why are those recent average wavelengths so short? The answer is very simple. If the 18-month cycle trough did occur in October, then we experienced a very short 18-month cycle. If we zoom out, then you can see we had an 18-month cycle into October of 2021, which had a length of 551 days. And then this very short 18-month cycle over here, which was only just a little over a year long. That very short 18-month cycle is the reason why all those shorter cycles have been found to have recent average wavelengths that are so much shorter than the normal average length of those cycles. Now, it is quite possible that the placement of this trough in October of 2021 is incorrect, and so what I would usually do is simply measure from the previous trough that we have some confidence in. I'm measuring back to the pandemic trough in March of 2020, so my confidence is not entirely certain about the position of that trough, but you can see that we have had 932 days. For two 18-month cycle troughs to have elapsed in 932 days is not impossible, but it does certainly make those cycles fairly short. Now, the important point that I wanted to make, and the reason why I wanted to show this analysis, is that when we have different average wavelengths on our analysis, we also have a slightly different position for our FLDs. And so when we are considering both of these possibilities, we must remember to take a look at both of these charts to consider what is happening. Here I have displayed the 20-day and the 40-day FLDs again on this chart, and you can see that here, according to this analysis with the 18-month cycle trough in October of last year, price crossed above the 20-day FLD. Again, we should take a look at median price, but I won't bother doing that here. As you can see, price crossed the 20-day FLD at a lower level, and that projects a lower target of only 40.75. So that is just over here, and is at about the level of the 40-day cycle FLD tomorrow. According to this analysis, price has crossed up above the 20-day FLD fairly well, making the chances that this is a GH category interaction much less likely. But would I have jumped into an A category interaction trade over here? No, because of the fact that we have the two possibilities and this anomaly that we are still trying to resolve. When watching this analysis, I would also wait until price comes down and forms the 20-day cycle trough at about the level of the 20-day cycle FLD, and that would provide us with a good trading opportunity on the basis of this analysis. Now let's take a look at gold. And as I've discussed in recent market update videos about gold, we have a similar situation in gold in terms of expecting a 20-week cycle trough to form at about this time. Possibly a 20-week cycle trough formed on Tuesday of last week, because price has indeed bounced up out of something that looks as if though it could be a 20-week cycle trough. As I've discussed in recent market update videos, I have two bar counts that have been running on gold in terms of the trough analysis, and again I will repeat the fact that I often mention when it comes to gold, which is that a trough analysis in gold is often less reliable than a peak analysis, which is why this analysis that you see has a peak analysis at the top of the chart and also a trough analysis at the foot of the chart. The analysis that we've been looking at in gold considers the fact that the very big cycle trough of 54-month magnitude formed either at the end of September or in the middle of October, or in fact in early November. There are the three possible trough positions. Usually in a stock market, troughs are sharp and isolated because of the fact that the cycles are synchronized at their troughs. However, in gold, the troughs are often clustered, and it can be difficult to resolve what the correct position is for the trough because, in my opinion, the cycles are best analyzed on the basis that they are synchronized at their peaks as opposed to their troughs. And so we've been considering two bar counts here. The one bar count counts from the end of September, where you can see the 54-month cycle trough has been positioned in this analysis. The second bar count considers the third possible location for that trough over here at the beginning of November. You can see that as of today, we have 159 days since that trough in September and 123 days since that trough in November. The average length, as I've mentioned previously, of the 20-week cycle discovered by Hurst 50 years ago is 136 days. The interesting thing about this situation is that we had three possible positions for that trough, and the central position in the middle of October was 131 days before the low price on Tuesday, making that low price on Tuesday a very possible position for that 20-week cycle trough. But here too, we need to ask ourselves, has this 20-week cycle trough now formed in gold, or is it possible that it's going to extend lower? I've added the 80-day cycle FLD over here, which indicates that the target that was generated as a result of price crossing below the 80-day FLD has not yet been reached. that target is somewhere over here. That is one possible reason to expect the trough to still lie ahead of us. However, given the very strong magnitude of this trough that occurred towards the end of last year, it would not be surprising to see downside targets failed to be reached. And if we add the 20-week cycle FLD, you can see that price has certainly found approximate support at the level of the 20-week cycle FLD, and that is what we would expect for the first 20-week cycle trough, following a trough of at least 18-month magnitude. And so in terms of the interactions between price and the 20-week cycle FLD, we have an A category interaction over here. And then we have the B and C category interactions at about the time of the 20-week cycle trough, where price is expected to find support at the level of that FLD and then bounce upwards. And so the evidence is certainly compelling that a 20-week cycle trough has formed in gold. And here is the final FLD that I would like to look at in gold. I've been presenting this 20-day FLD in recent market update videos about gold, and there are of course two FLDs displayed here. The reason for that is because one of them is based upon the trough analysis and the other FLD is based upon the peak analysis, which I should remind you are two completely separate analyses. I've been discussing this 20-day FLD in recent update videos. The reason for that is because following a trough of 20-week magnitude, we would expect price to cross above the level of the 20-day FLD and to reach its target to the upside. That target is at a level of about 1860. The interesting thing about plotting both a trough FLD and also a peak FLD is it reminds us to take a look at the interactions between price and the peak FLD and consider them in terms of the peak analysis. And so when price crosses down below the FLD, which it did over here, that would be our A category interaction for the peak analysis. I'm going to label that AP. At about the time that the 20-day cycle peak forms, we would expect price to find resistance at the level of the FLD. That would be a B and then C category interaction in the peak analysis. So again, I will label those BP and CP. I mentioned the fact that the 20-day cycle peak probably had formed and that instead of finding resistance at the level of the FLD, prices simply failed to get all the way up to that FLD. Price was then expected to cross up above the FLD on its way to this 40-day cycle peak. That, of course, would be labeled a D for the peak analysis, DP category interaction. And so we have an interesting situation in terms of the interactions between price and the FLD and the fact that we are watching both a peak and a trough analysis. This D, based on the peak analysis category interaction, is also an A category interaction, potentially in the trough analysis. In terms of the quandary that we have whenever considering the first interaction following a potential trough of 20-week magnitude and whether we are going to witness another GH category interaction or whether this is the expected A category interaction, you could certainly have entered into a long trade in gold and purchased some gold based on the fact that we are expecting this 40-day cycle peak to occur sometime next week and we would expect price to reach up and achieve that target. Or if you were a little more cautious and you're focusing on the trough analysis, then again you would wait until price finds support at the level of the 20-day FLD, which would confirm that the 20-week cycle trough has formed. Finally, let's take a look at Bitcoin. And I don't have very much to add over what I last said about Bitcoin, which was, I think, 2 weeks ago, because Bitcoin has been behaving pretty much exactly as we expect on the basis of this analysis. The thing that I would like to point out about Bitcoin, which I've mentioned before, is the fact that both the peak and the trough analysis provide us with interesting information, because Bitcoin seems to respond to both analyses almost equally well. I've left the pin symbols on this chart to show you that I have had to influence this analysis a little bit in terms of pinning these peaks at these positions. The important thing about what is happening to Bitcoin at the moment is that an 80-day cycle peak formed according to this analysis towards the end of February, and that 80-day cycle peak formed when we had a whisker of the 18-month cycle very much within range. We need to stay alert to the possibility that an 18-month cycle peak has formed early. That 18-month cycle peak nest of highs, you can see, is actually centered over here in about the middle of April. And so I am still expecting another move up into another high, which would then be the 18-month cycle peak. But we need to stay alert for the fact that that 18-month cycle peak might have occurred early. In terms of the trough analysis, we have a very neat stack of circle and whiskers, or a nest of lows for the 40-day cycle trough over here in the third week of March. And the interesting thing about this is that we have a circle for the 20-week cycle, which is floating above that 40-day cycle nest of lows. When you see that happening, it is an indication that we should stay alert for the fact that this 40-day cycle trough is actually going to turn into a bigger magnitude cycle trough. Why does this happen? It happens because of the fact that a cycle in between the 40-day and the 20-week cycle, which is of course the 80-day cycle, has been phased in a position that isn't entirely conforming to the recent average wavelength of that cycle. And in fact, if we measure the number of days that elapsed from the very big 54-month cycle trough that I believe occurred in the third week of November up until that 80-day cycle trough here in the middle of February, you can see that 84 days elapsed. The average length, as I've already mentioned several times in today's video, of an 80-day cycle is 68 days, and so that was a late 80-day cycle trough that formed. However, I should point out that it formed after the very volatile price movements that followed the FTX news events and the various news events that have been shaking the crypto world recently, and this very strong move down and this very strong move up over here were very largely influenced by news events happening at the time, and they have potentially distorted the cycle analysis. Nevertheless, the things to look out for in Bitcoin are the formation of this 40-day cycle trough, which we are expecting in the next week or two, and then we would expect price to bounce out of that trough, bearing in mind that it could possibly be an early formation of the 20-week cycle trough, and then we'll be looking for this next peak, which is expected in about the middle of April, and quite possibly will be a higher peak than the recent peak that we have seen in February, because of the fact that it is likely a peak of the 18-month cycle. I do hope that you found this market update useful and interesting. If you have any questions or comments, please join us on our Discord server, or you are very welcome to post them in the comments below this video. I look forward to hearing from you.